The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, we saw a fairly quiet day once again on Tuesday. Kind of got that same theme going here at this market as we've kicked off the week. Is this grain trade largely marking time until the end of the month reports here already, a little over a week out? Also saw some pressure in the livestock trade too. Kind of just not a lot in the way of fresh news to talk about, but we're going to try and dive in and make some sense of things and get some perspective from Brian Splitt with agmarket.net joining us here on the show today. Brian, it's good to catch up with you again, my friend. And it's March Madness season. Have you filled out your basketball brackets yet by chance, since the markets have been so eventful here the last couple of days, Brian?
No, I haven't done it yet, but we are doing one at Ag Market with brokers and outside people are welcome to join and compete just for good fun and bragging rights. But I'm usually a last minute guy. I don't watch a whole lot of college basketball, but I know Matt loves U of I and Jim loves Purdue because that's where they went. And you got a Wisconsin guy up here in Jacob. So I like watching them banter back and forth about it. I was a Marine, so I really don't have a allegiance to a college, right?
Well, I know I'm with you. I don't watch a ton of college basketball. I did put my bracket in your guys' Ag Market challenge there on ESPN. So we'll see if I can get some bragging rights out of it. Probably not. I'm probably going to be in the lower bottom end of the picks on that one, but we'll see. Anyway.
Well, good luck to you. Hopefully you can beat Matt and Jim.
We'll
so
see.
Rub it in. Yeah.
Fingers crossed on that one. Fingers crossed. And then maybe you could beat me. You throw a Hail Mary bracket out there and maybe it'll win. Okay. Well, looking at markets, kind of back to an original thought there. It's just kind of quiet. I mean, there's not a lot of fresh news to really, make us pay that much attention. I mean, corn, for instance, on Tuesday, we had like a 5, 6, 7 cent trading range. I mean, just feels like these markets are already marking time until the end of the month here, Brian.
Yeah, and it was low volume trade today too. So there's just as you mentioned, not a lot of news, not a lot of excitement to push the market around. But that's good that the market isn't going down in lack of news. When we were trending lower into February, a no news day was a down day. And a news day was an even bigger down day. So we're just not seeing that, hey, status quo means sell it. And that's good. I think when you look at how corn made lows in February, I think we're going to go higher. I don't think it's going to be an exciting rally. I don't think we're going to get that type of rally where corn will bite off 30 cents in a couple sessions. That's just not how it's going to trade. You and I talked a lot last year about 2013 versus 2023, and that relationship held pretty true all the way through the expiration of December corn. Then that followed through into the March contracts. And so, 10 years ago, corn made lows in early 2014 at 406 and a quarter on the front month contract. That would have been the March at that point. We went to 394 and a half this year, so about a dime lower. But interestingly, 10 years ago, we were coming off of the 2012 high, right? That was the peak. This time we're coming off the 2022 high. So if you took that measurement from 2012 high to early 2014 low, and then took the same value, that same amount break from the 2022 highs, that would have suggested 389 and a half. So again, we went to 394 and a half, about a nickel away. So it's been the same size break off the high. So then we recalibrate what did we just do in February? We set our spring averages for crop insurance. 10 years ago, corn's revenue level, the guarantee was 462. This year it's 466. 10 years ago, the bean guarantee level was 1136. This year it's 1156. So for all intents and purposes, in the month of February, we are right where we were a decade ago. So then you fast forward and say, well, what did we do going into spring, summer? It was an early high. Corn made its highs in April and in May, right? So we started to rally going into the quarterly stock report with the acres. We eventually made highs in early April and then a secondary high in May for corn before breaking. That high was 517. So to me, it makes the gap at 503 on this year's chart look very reasonable as far as an upside target. When you think about beans in 2014, we made a rally. There were three distinct highs. One was April, one was May, and one was June. Your April and your June high were about the same price. The highest of the three highs was in May. That was a big head and shoulder top. Now that peak, the highest of that rally was 1279. So again, it makes the 1244 and a half high or 1244 and a half gap on the current November chart look again very reasonable. It's 60 cents away from where we're trading right now. That is not a lot in beans. So that all looks great and sounds great, but then what did we do going into fall? And I think the balance sheets are lining up for a potential repeat of that, because if we do have adequate acres with a good yield, we know that the balance sheets for corn are going to grow. We're going to be inching from the low 2 billion type carry out to mid to upper 2 billion. If we get a lot of acres, it could be even worse than that. We'll see. But we made lows in 2014 in October at 318 and a quarter. We made lows in October in 2014 on soybeans at 904. So you had a nearly $2 break in 5 months on corn and a $3.75 break in beans in about the same period of time. So I'm short-term optimistic. I do think we could see some continued short covering. We just saw very brief, we're like 1 week into short covering in beans. We're a couple weeks into it in corn. I think we're going to get more than that as far as the amount of time that we spend by the funds of reducing their short position. But I fully believe they're going to ram right back into the shorts as we get through the growing season and take it really quite a bit lower into fall.
It makes me think, you mentioned some of those targets, some of those gaps, that if, we put a 5 in front of some of these corn contracts again, or if we put a solid 12 in front of some soybeans, I mean, I wonder if that could trigger some farmers selling, if we could get some of those magic numbers on the board here, Brian.
Yeah, and it's probably one of two things. We've just seen it over the years where everybody's watching the gap. So either it's just going to not quite get there. Everybody that's trying to sell the gap, it's going to miss it by a little bit, and then they're going to have to chase it lower. Or, and this is also a potential outcome, everybody's going to try to front run it, right? Sell it at 485, 490. And then we're going to break through 5, and everybody that was bearish is going to turn bullish, and then they're going to buy the highs, and then it's going to roll over. We've seen that too. So I just think this is a time where you got to stay pretty disciplined. If you sell $5 corn and it goes to 515, just remember what your big picture thought process is and where we expect things to be in 5 to 6 months.
Is there anything else? Crude oil's been strong here as of late. We've seen wheat get a little bit of this geopolitical risk back in here, supposedly. Any support from wheat or crude oil maybe helping out quart of beans here with a little bit of a lift potentially? Any thoughts there, Brian?
Well, I'm watching Chicago wheat, the new crop July contract, and today we basically got to the downtrend on the chart. May have closed a hair above it, not convincingly so. And we stalled just shy of last week's highs. So I think tomorrow, if we do see some continued buying, then we're going to decisively take out the long-term downtrend. We're going to break through last week's highs. We're going to take out the 20-day moving average, and we're going to accomplish multiple positive things all at once. Until that happens, we're at resistance. So hopefully we can see this short covering in wheat continue. And I do think that if wheat could get through this resistance and form a bottom, that would go a long way in helping corn go up with it. The thing is right now is that the funds are short everything. So we're not likely to see one of those types of trades where they're going to come in and, if they start buying wheat, they're going to sell corn. They're already short corn, a lot of it. It's not likely where if they're going to start buying wheat, they're going to sell beans. They're already short beans, a lot of it. It was just a record a week ago as far as the size of their short position. So I don't see much intermarket spreading in the short term. I think it's going to be more of, hey, either we are reducing our short position across the board, or when they decide to go short again, they're going to sell everything. So I do think some continued strength in wheat would be positive across the board and lead to additional short covering in corn. And, recently we were hearing that wheat was penciling into some rations for feed. So with everything going on, I think there's some positive price action in front of us for the next, I don't know, 4 weeks, 6 weeks, something to that effect.
Well, we are talking today with Brian Split from agmarket.net. Brian, let's go over to livestock here and talk a little bit about cattle and hogs. Charts that you're watching there. Kind of quiet day in cattle Tuesday. We had a solid start of the week on Monday. I have to wonder if the trade's already looking ahead to that cattle on feed report on Friday. I guess cattle wise, anything big you're watching on those charts technically right now?
Yeah, all the strength seems to be in the deferred contracts. When you think cattle on the live side, you go out August, October, December. Those are the ones that have been making some new highs here for the move recently. You look at the nearby, like April. If I'd have talked to you last week or the week before, or probably the week before that, we're at the same spot. We've been just sitting here. They keep buying it in the 186 area. They're selling it around 190. We're in a little bit of a consolidated range. The April contract needs to make a decision here soon because we're in a nice uptrend, but we haven't been able to break out to the upside and make a new round of highs. And so just by default, if this market can't break out to the upside, it's going to start failing through this uptrend that we've been in since the lows in December. And just by way of not staying above that uptrend, that could lead to technical selling. So cattle kind of needs to make a move here or it's going to start looking negative by default. There is a seasonal for June cattle to point lower here. So that's something that we should be mindful of. And again, I think option values are pretty reasonable on cattle. And so just knowing that we have hit a lot of our targets to the upside, April cattle filled its gap, right? That was the last remaining gap on cattle charts. We've retraced 62+% of that whole move from September to December. So a lot of the upside objectives have been met, and we need to see some new, fresh information to start making some new highs. Otherwise, I just think it's prudent to have some risk management here because I remember how it felt when we had that break from September to December, and it was relentless, and it seemed like the lower we went, the bigger the moves we're getting. And I don't want to live through that again this year. So again, I think it warrants having something under the market, at least have some kind of put coverage. There's a lot going on in the world right now. You look at stock market valuations and it's trending higher. There's no doubt about that. But some of these stocks that are leading the indices are trading at multiples of their earnings that really are bubbly type numbers, right? So there's a saying, right? And everybody knows that the market can stay irrational longer than you can stay solvent. And the stock market can still go quite a bit higher if it wants to. But boy, if something breaks there, I think that would take a lot of the positive kind of sentiment towards the economy out, and that would affect the sentiment towards beef demand. So it hasn't happened yet, but again, the stock market's going to be something that I think will have an influence on things. And you've got 60% of the world is going to have an election this year. Just a lot of potential for some tumultuous type trade because of geopolitical events worldwide.
No, and that's a great point you bring up. I was going to ask about stocks and we just saw hot CPI and PPI numbers last week, kind of throwing in that inflation play too. And on top of all that, we're getting into summer grilling season typically, but if we see an economy that maybe gets a little topsy-turvy, that may, we may not have that summer grilling season like we normally see here, Brian. And to your point, there's quite a few things kind of lying underneath this entire protein sector right now, Brian.
Yeah, I mean, there's a lot of people living on credit card debt right now, and this is not credit card debt at low interest rates, right? I mean, interest rates have moved higher. I saw I saw a video as a young, I think the generation would maybe be Zoomer, right? If I'm
Mhm.
getting my generations right, but she literally thought that a credit card was just like free money, and if you had an $8,000 limit, that was as much as you could. And she didn't understand the concept of debt. And so there's, I think, a younger generation out there that doesn't quite understand fiscal responsibility and is racking up credit card debt, auto loans. I mean, the whole thing. So what was the statistic I saw the other day that credit card debt now matches mortgage debt, right, as
Wow.
a sheer nominal value? Um, those lines aren't supposed to cross, right? What do they say in Ghostbusters? Never cross streams, right? Those two streams should not be crossing.
No, and that's a great point you bring up. I think that speaks to the broader fiscal health of our economy right now, and there's some things to definitely be concerned about. Brian, real quick, I was just going to ask you on the hogs. I didn't look at a chart today, but it felt like kind of some overhead technical resistance that we fell off of there. Any quick notes for us in the hog trade?
Yeah, what was this? Maybe 2, 3 sessions ago, April lean hogs hit their current downtrend from the most recent peak. It couldn't get through that, so we're seeing a pullback there. Summer contracts behaving big picture better. Where your June, your Julys, we've been able to make some new highs here recently. So much like cattle, it seems like there's definitely more interest in some of these deferred contracts. But we're over 100 right now. Could we go higher? Sure. But again, it's just from a pure risk management standpoint, it seems like a level that's worth protecting in one way, shape, or form. It does seem in retrospect that break in the hogs that we had in late 2023 was coinciding with China liquidating their hog herd. And
Mhm.
that liquidation is what provided a bottom for us. So now we're going to be on the upswing of where they're going to need to reestablish that herd, and then it'll get too big again, and then they'll liquidate it again. That's the cycle over there. But we are on the upswing right now, and I think that's part of what is the outcome of China's actions several months ago. And so, that's something that we need to watch for, because how they handle their hog herd has a lot to do with their crush margins, and whether they're going to import beans to crush them and make money crushing them to feed their hogs, or if they're just going to go straight to the meal product and buy meal. There's been some talk and a little bit creeping in about Argentina and the amount of rain that they're seeing, and too much rain during harvest. And it's actually, there was a heck of a rally in 2016 in beans that happened in spring. It was a really weird time of year, but that rally came because it was flooding in Argentina. So they had this really nice bean crop, and then it was stuck in the field, and then it started flooding, and it took, I don't know, I think we priced in at the time maybe that it was going to take about 8 or 7 million tons of their crop away. It ended up being about half of that. That's how the market reacts. It overreacts, right? And so that provided a really good opportunity where the market went up substantially in a short period of time. So I think that is worth watching. How much rain do they continue to get? Does that forecast stay wet? Because if it does, again, we know what happened last year when Argentina had a drought. They are the #1 meal exporter in the world. And so something like that will get this meal market to get excited if we see that evolve further, and that will really help the bean market rally. So watch that. You had asked about crude oil. I will tell you, RBOB broke out to the upside. We're actually making new contract highs the last couple of days in RBOB. That's unleaded gasoline. And we're trading on your nearby contracts above our September highs. So those were our fall highs that we corrected hard from. And now RBOB is leading the charge between crude oil, RBOB, and heating oil. And heating oil is your diesel fuel proxy. So RBOB is leading the way. We actually have RBOB trading at about par with heating oil. Usually heating oil will have a 30 to 60 cent premium over RBOB. That doesn't mean buy RBOB or buy heating oil and sell RBOB, because that can get stretched the other way, where RBOB holds maybe a 30-cent premium to heating oil. But when it gets in that area, it's not there for very long, and then it whipsaws the other way. So it does look like the markets are breaking out to the upside in energies, led by unleaded gasoline, with right now crude oil coming next. And crude oil broke out to the upside last week above some recent highs. So that looks like it's got some upside potential. And hopefully, if that's the case, then that provides some general support to commodities. There is a good correlation between crude oil and soybean oil. We've seen Malaysian palm oil make a really nice run here. So hopefully the products here, whether it's bean oil or bean meal or the combination of the two, can help pull beans higher here in the short term.
Well, Brian, we could take even a quiet market day and have an interesting conversation. Do appreciate the time. And I know folks, if they have questions, want to check out your guys' intel and more there at agmarket.net. I know going online is probably the best way to get in touch, isn't it, Brian?
Yeah, it's easy. Just go to www.agmarket.net. We're going to have a new app that we're unveiling April 1st, and that'll get all of the intel will get pushed to you directly through the app. And if there's somebody at the organization that you want to talk to directly, our phone numbers are on the website.
Brian Split, agmarket.net. Always good to chat with you, sir. Thanks for joining us on Market Talk. Have a great week. We'll talk to you again soon.
All right. Likewise, Jesse. Thank you.
And thank you very much. Brian Split with agmarket.net. That's going to do it for Market Talk today. I'm Jesse Allen. Have a great rest of your day.